Oh, thanks, David, for having me on. And,
Oh,
first of all,
yeah.
on the introduction, we've had the inflation for years. The Fed has been creating inflation. They just call it quantitative easing, but what they're really doing is creating inflation. What finally happened recently is that all that inflation showed up in a very big way in consumer prices. I mean, it was there before, it just wasn't as obvious because the increases weren't as big, and the government did its best to cover them up with a highly rigged CPI that has been understating the rate at which prices have been rising for years. And by the way, we are in double-digit price increases if we accurately measured those increases. It's only because of the inaccurate measurement that we're using, the CPI, that we're still under 10%. But if we measured prices today the way we measured them back in the 80s, because we often want to compare today's inflation to the 80s and 70s, it's actually north of 15%. It's actually worse than any year of the 1970s.
I spoke to an economist about that, Steve Hanke, actually. I asked him, why is it that people are complaining about the government's underreporting inflation? This is his answer. I want you to comment on that. He says, maybe we're just outliers. Maybe our spending patterns are different from the average Joe's. And so what we notice is an increase in double digits of whatever we usually consume. Maybe you and I, Peter, just have an expensive lifestyle is basically his answer. How would you respond to that?
Yeah, well, it's just that the government statisticians live in a fantasy world, and the average American lives in reality. But no, the answer to the question is we deliberately changed the CPI. I mean, nobody pays owner's equivalent rent. So why does the government use a number that no American pays as the largest component of the CPI? Why not use actual rent, the rent that people pay? Because that number is triple or quadruple this number that the government has concocted. Or why not use house prices that are actually going up more than rents? Because people actually buy houses and they have to pay those prices. And they've made other changes to the CPI that did not exist prior, all the substitution where the basket is not the same, but it constantly changes. They take out the stuff that went up and they put stuff in that went down or didn't go up as much. And they have ways of hedonically adjusting things. So they claim that prices didn't go up when they did, or claim that prices went down when they went up, because they're making a subjective assessment of quality. But oftentimes I think they reduce prices when quality goes up, but they don't increase them when quality goes down.
So you have an issue with the components of the CPI. Okay, that's understandable. So why do you think they're doing that? Let's assume you're right and they're underreporting what inflation should be. Do you think there's maybe a political incentive to underreport CPI?
Well, of course. My dad used to say trusting the government to give you accurate information on inflation is like trusting the mafia to give you accurate information on crime.
Was your dad Russian? Did he live in Russia?
Well, no. Actually, his parents were from there, but he was born in the United States. But the point is, look, the government has every reason to understate inflation. In fact, when they first did it, it had to do with the budget. They were trying to reduce spending on Social Security and Medicare, but no politician had the guts to actually reduce Social Security or Medicare. So they found a way to reduce the COLAs so that they wouldn't be increasing them by the true rate of inflation. And so they changed the methodology for calculating inflation. So it enabled the government to cut spending without officially voting to cut spending. So that's how it started. But it delivers all sorts of benefits to the government, because by understating inflation, you also overstate growth. Because whenever they take the GDP numbers, they use that inflation rate to deflate it, the GDP deflator, because they want to show what's happening to the real economy and take inflation out. And so when you pretend that inflation is lower than it actually is, it makes it appear that the economy is growing faster than it actually is. And all politicians want to take credit for economic growth. And so by lying about inflation and underreporting it, they can pretend the economy is much stronger than it actually is. But more recently, it's the Federal Reserve that's been able to hide behind these doctored inflation figures as a pretense to continue its reckless monetary policy. The Fed has been able to justify 0% interest rates in QE on the basis of inflation still being below their 2% target, which, first of all, 2% was never a target. It was supposed to be a ceiling. It wasn't like if inflation was 1%, they had to get it up to 2%, but they turned the ceiling into a target in order to pursue an inflationary monetary policy. But inflation was never too low. That was just a canard. That was just a false excuse for the Fed to do what it wanted to do, which was to prop up government spending, to continue to blow air into a bubble, to artificially push up stock prices and real estate prices. But it didn't want to admit that was its goal. So it came up with this ridiculous goal of that there not being enough inflation and trying to raise the inflation rate. Well, all the years the Fed was pretending this was their goal, I was warning what was going to happen when they overshot. Because eventually I said the official numbers would be much, much higher than 2%. And then the Fed would be in a box because it would be impossible to ever bring the rate of inflation back down to 2% without completely destroying the bubble economy that low interest rates and QE had inflated.
We're going to come back to how they're going to fix this problem if there is a solution. But first, let's talk about the root causes of this problem that we're in. Now, you've talked about how asset prices have moved up first before CPI, and that was correct. And you've talked about how monetary policy, the failed monetary policies of the Fed, have created this problem. Let me ask you this, Peter. QE is not a new phenomenon. We've had QE before in the early 2000s. Why didn't we have higher CPI back then? Why did it happen only this time around?
Well, first of all, I think we did have higher inflation back then. And in fact, had the government not done QE, we may have actually had falling prices in 2009 or 2010. It was the Great Recession, so prices probably should have come down. But because of all the inflation we created, they went up instead. And of course, they went up by more than the government admits because we're still looking at the CPI. But the reason it's so much worse now than it was back then is because we've printed so much more money. Look at the enormity of the QE program subsequent to COVID. And, look at the number of dollars that have been put into circulation over the past couple of years. A lot of the QE that was done, following the financial crisis was mainly focused in the financial economy. So you saw a much bigger impact on asset prices like stocks and real estate. But this time around, the government sent all these checks directly to the people that they went and spent. In fact, the worst thing they did, and I pointed this out real time, is they told people not to go to work and to stay home. In fact, in many cases, people were ordered not to work and to stay home. So people couldn't produce goods, they couldn't produce services. Their spending should have gone down because they weren't producing as much, so they should have spent less. And that would have meant a recession, of course, but the politicians didn't want that. So they told the workers who were taking a vacation, we're gonna send you money. In fact, we're gonna give you more money than you used to earn when you had a job, even though you're staying at home, and we want you to go out and spend that money. Well, spend it on what? Nobody was making anything. So when you make less stuff, but you print more money to buy stuff, prices have got nowhere to go but way up because the government didn't create any stuff. They just printed more money to buy stuff. And the other reason that the inflation was not as big is because we were able to export the inflation to our trading partners. We run these enormous trade deficits, which are now at all-time record highs. They've just blown through the roof as far as the size of these deficits. We take the money the Fed prints and we send it over to China, and the Chinese send us all the goods that they produce. And they take those dollars and they buy treasuries or things like that. But so that helps keep a lid on consumer prices, but it also helps reduce interest rates and prop up stock prices. So we've benefited from that. But I think that dynamic is going to change. I think a lot of the money we've exported is going to come back and prices are going to be bid up even faster.
Okay, let's talk about asset prices in response to inflation. Let's assume the markets are as smart as you, Peter. Let's assume that everybody isn't buying into the government numbers that you claim are inaccurate. You're not the only person to say this. A lot of people agree with you. So let's assume the governments are underreporting inflation. Let's assume the markets know about this. If I'm an analyst and I'm analyzing a stock, I'm making a discounted cash flow analysis on a stock. I'm not going to use 7.9% inflation to project higher costs for next year. I'm going to use 12% or 15%, whatever the case may be, that I think is a reasonable number. And so the stock should be, valued lower because their margin should be shrinking based on these higher cost numbers. Is that what's happening right now? Do you think markets are accurately pricing in inflation?
No, I don't think they're accurately pricing it in yet. I think the markets are still delusional with respect to inflation. I think most analysts still expect that what we're seeing is transitory. They just think the transition is taking longer than they first thought. They still think the inflation is driven by supply chain bottlenecks or the war with Russia and Ukraine. And so they think that all this stuff is going to unclog and prices are going to magically stop rising. But that's not going to happen. I mean, the inflation is being caused by the government, by the Federal Reserve. And I see the budget deficits and the trade deficits getting bigger and bigger. And so the Federal Reserve is going to continue to create more inflation. And even though the Fed has raised interest rates, they're still at 0.25%. Inflation, even if you buy the government's version of inflation, that is 8%, how are you going to put out 8% inflation fire with a squirt gun of 0.25% interest rate? I mean, that's never worked. Interest rates are historically negative. I mean, Paul Volcker in 1980, to finally get rid of inflation, rates went to 20%. The highest inflation got in 1980 was 13.5%. So he had 6.5% real rate to bend the inflation curve. How are we going to bend that curve when we have negative 7.5% interest rates? There is no incentive to change your spending and borrowing and consumption patterns with a negative 7.5% rate. It's not like people are going to be incentivized to start saving now because they want to earn that negative 7.5%. Of course not. People aren't going to stop borrowing even though they're getting paid 7.5% to borrow. A negative interest rate means you're being paid to go out and take out a loan. So people are going to keep doing that. Nothing is going to change. Inflation is going to keep getting worse. The Fed is actually pursuing an inflationary monetary policy under the guise of fighting inflation. You know, just because you're less loose than you were before doesn't mean you're tight. And of course, you're not even less loose because inflation is accelerating faster than the Fed is hiking rates. So rates in real terms are actually lower today than they were many, many months ago when the Fed first started contemplating the first quarter-point rate hike.
That's right. Real rates are still negative. All right, so let's talk about Fed's policy. What can they do to fight inflation, assuming they even are interested in really fighting inflation? You've tweeted this, and I'm just going to read one of your tweets from yesterday. You said, Powell admitted price stability is so important to the long-term health of the labor market that the Fed may have to keep hiking interest rates to bring inflation down, even if unemployment rises. The same would apply to asset prices falling. This resolve will soon be tested. All right, what do you mean by that? Are you saying that it's either or, either the labor market or inflation? We can't have both?
Well, the economy that we have today, and I call it a bubble, it's a phony economy, it is completely dependent on artificially low interest rates, on all this credit-financed consumption and wealth that comes from inflated asset prices. So we've got this drugged-up economy, and we need to remove the drug. Well, you can't do that without collapsing the economy. It's like, you know, if you're high on drugs, is there any way that you could kick the habit and stay high? No. I mean, you stop taking the drugs, you're not going to be high anymore. You're going to go through withdrawal. So, yes, the Fed can fight inflation if it wants to, but if it fights inflation, it's going to have to collapse this bubble economy that was built on its cheap money, because you can't fight inflation with cheap money. You got to take the cheap money away. and interest rates have to rise dramatically, not just a little bit. They have to go way up. And the government has to really start shrinking the money supply, or the Federal Reserve. They have to start reversing quantitative easing. They can't just slowly allow their balance sheet to run down. And by the way, look at their latest numbers. The week just ended on Wednesday. The Fed added another $45 billion to the balance sheet. It set a new record high. They continue to monetize government debt. You can't do that if you want to fight inflation. That is creating additional inflation. So the only way that the Fed can truly fight inflation is to allow a massive recession, a complete collapse of this phony economy, and it's going to force the U.S. government to make some hard fiscal decisions that it's never made, because it's not going to be able to finance its deficits if the Fed is fighting inflation. So we're going to either have to have massive cuts in government spending, including entitlements like Social Security and Medicare. We're going to have massive increases in taxes on the middle class, not on the rich, on the middle class, working Americans, or some combination of that. Or the government might have to default on its treasury obligations. These are the things that the government's going to have to consider if the Fed were to actually fight inflation, which is why I don't believe the Fed. I don't think the Fed's going to fight inflation. In fact, if they were going to fight it, they would have already done it. We wouldn't still be at 25 basis points in interest rates. They wouldn't have finally raised interest rates on Wednesday if they were committed to fighting inflation. They would have done it a long time ago. They wouldn't have continued quantitative easing when it was obvious that we had an inflation problem. I mean, even after they admitted that they got it wrong and inflation was not transitory, they kept printing money. They kept monetizing debt. They kept interest rates at zero. So I don't care what the Fed says. I look at what the Fed does, and their actions speak a lot louder than their words.
Okay, let's assume that the Fed is going to take your plan and say, we're going to really hike up rates to a level where a default may actually be necessary. I'm not saying they will, but let's just say that happens. What's going to happen to the stock markets? What's going to happen to gold in that scenario?
Well, the stock market's certainly going to crash. There's no question about that. The bond market's going to crash. The real estate market's going to crash, right? All of these assets that have been propped up by artificially low interest rates are going to collapse. Now, what happens to gold prices, it's hard to say. I mean, gold prices could go down in that scenario, but they would go down a lot less than stocks, bonds, and real estate. So people would still be better off in gold than owning these other assets. But personally, I think if we got to a situation where the U.S. government was defaulting on its debt, I think that would be very bullish for gold. I think people would be rushing out of dollars and out of U.S. treasuries, and they would be seeking out the safety of gold. So I think kind of gold's going to go up either way, but gold will go up a lot more if we don't do that. If instead we inflate our way out of it, if we never fight inflation because we don't want to deal with those consequences, if we keep on printing money and monetizing government debt, then gold prices are going to go up much more. I mean, maybe stock prices will go up in that environment too, but in real terms, they'll go down even more priced in gold than in the alternative scenario where we do the right thing and everything crashes.
Okay, let's touch on gold real quick. Just have one question about gold. You've mentioned that inflation has been rising for quite a while. Why is it that gold hasn't moved until actually relatively recently? In the last couple of months, it's moved up, but still it hasn't breached its August 2020 high. So what's going on there?
Well, first of all, you have to put everything in its context and kind of zoom out a little bit and look at the gold market, because in 2001, gold was under 300. So it went on a very big move from 2001 to 2011, from under 300 to almost 2,000. I mean, it got to over 1,900. And then we went on a substantial correction where gold dropped from 1,900 almost back to 1,000 by December of 2015. So that's when the market stopped falling. And that was coincidentally when the Fed hiked rates for the first time after having held them at zero for many years. And that actually marked the bottom in that correction. And so then gold gradually basically doubled in price over the years. And so it has been going up. It's just that everybody wants to compare it to its peak in 2011 and forgets where it came from 10 years earlier than that. But I think one of the reasons that we haven't seen a bigger move up in gold yet is because we've had a speculative mania in risk assets. I mean, I think 2021 really was the peak. If you look at what happened, with the meme stocks, NFTs, cryptocurrencies, the popularity of all the crypto gurus, stock market gurus like Cathie Wood and her ARK Innovation ETFs and things like that, investors really threw caution to the wind. They didn't care about fundamentals. They bought anything that was going up. Everybody was going to get rich speculating. That's not an environment where gold's going to shine. I mean, people weren't worried about anything. They didn't need a store of value or a safe haven. They didn't need an inflation hedge. They wanted to get rich quick. And that's not what gold is about. So I think in that environment, it doesn't surprise me that we didn't see a lot of interest in gold. But as the air is coming out of those bubbles, which I think is going to be happening, I think 2021 was the peak of crazy speculation. And as it starts to move from an environment of greed to an environment of fear, as reality rears its ugly head and people finally realize that inflation is here to stay. Because at first people said there's no inflation at all. Then they said, okay, we've got inflation, but it's transitory. And then they said, okay, it's not transitory, but don't worry, the Fed's going to quickly rein it in. Once they realized that that's a lie too, that the Fed is not going to reduce inflation, that inflation is here to stay and it's going to get worse, well, that's when you're really going to see people piling into gold.
Okay, so gold's going to go higher. What do you think inflation is going to do? You've already called for higher inflation. We've got higher inflation. Is it going to go much higher, Peter? What about next month's reading? Is it going to be higher than 7.9, you think?
Well, I don't have a crystal ball, so I can't
nobody
tell.
does, yeah.
But obviously next month is going to be higher because it's going to capture the big price increases in March. So, most people expect the March number to be pretty hot. But again, I wouldn't put it past the government to find a way to alter the CPI again, to find some other way of calculating these price increases to make them appear that they're smaller than they really are. But, the real inflation that everybody experiences is going to get worse. I was saying last year that 2022 was going to be worse than 2021 because I know in 2021, a lot of businesses were absorbing their cost increases and not fully passing them on or not passing them on at all because a lot of businesses were also convinced that this was transitory. And so they just waited it out. They said, why should we bother hiking all of our prices when this is just temporary? We'll just take a hit in the short run to our margins. We don't want to risk losing customers to competitors. And so we'll just eat it. But now in 2022, that they realize that they were mistaken, that inflation was not transitory, that it's permanent and going to get worse. Not only are they raising prices to reflect what's happening in 2022, but they're trying to catch up to what they missed in 2021. So now consumers are going to get hit with a double dose of price increases. And so I think that 2022, if accurately measured, is going to be higher inflation than 2021. And I think that would have been the case regardless of Russia invading the Ukraine.